I think the further you go in this space, the more you go back to the basics. You will not feel this pressure to put your money to work for you because your money is working for you. So my best investment is my business. I have learned not to oversell it. You'll be very patient in waiting for the best possible deal. And when that deal comes, you will not need me or anybody else to push you or persuade you. You will know.
Hi, everyone. This is Jack Allwell with another Money episode. Today we got returning guest Logan Hertz from Hazeltine LLC. Logan, it's good to see you again.
Jack, good to see you too. Good to be back. It's been way too long. Let's not let
It
it
is,
go so long between episodes next
yeah,
time.
yeah. It has been too long. And I feel like you're one of my IBC guys, and I am happy to have another conversation. What's new with infinite banking, and what have you been seeing?
Yeah, it's a good question. I think the further you go in this space, the more you go back to the basics. It's kind of counterintuitive, because most people just need the basics. And I'm talking about very sophisticated, successful people. Most people have never heard of the infinite banking concept. Most people don't know very much about if whole life insurance even exists or how it can be utilized. Their idea of whole life insurance is either very caricatured or it's very bare bones. They don't really know all of the things that you can do with it and how it can be designed. Most of them, if they think of whole life insurance, if they've ever seen an illustration, which they probably haven't, but if they have, it's probably what we would call an all base contract, which is perfectly fine, but it's not really appropriate for the sort of strategies we do. And I hear it all the time from very sophisticated investors. In fact, I have a client who is a portfolio manager working at a bank for high net worth individuals. He had no clue that you could do any of the things that we're talking about. And now that he's a client, he's trying to talk to his colleagues who are also portfolio managers, attorneys, other people, other financial professionals dealing with high net worth individuals, and they just don't believe him. They don't believe that you can do these things. So the feedback, the challenge with me in this space is, of course, you and I like talking about these super advanced use cases, right? Um, and that's kind of there is a market for that. There are people who want to hear that, but there are probably people who are already doing the infinite banking concept. Really, most people need just the basics, especially the people who think they know it, right?
Mm-hmm.
The people who have done enough research to be dangerous, where they think they know how some of the stuff works, but they really don't understand much under the surface. Um, so yeah, I have learned not to oversell it and really just to stick to the very basic concept. The idea that you can build capital in a safe, tax advantaged way in whole life insurance policies. And then you can utilize that capital without interrupting the earning in the policy. If you just stop right there, most people have no idea that you could even do that, right?
Mm-hmm.
And then the next layer of nuance was they would have no idea of how we can design the policies, right? When you're working with someone like myself who knows how to design these policies, which is an advanced skill, they're used to seeing policies where, yeah, but it takes 10 years before you have anything worth borrowing, right?
Mm-hmm.
Well, not the way we design policies, right?
Yeah. I'll just say, like, I mean, I worked as an actuary for over a decade. I'm working with insurance, you know, products, annuities, and we had exams on like the modified endowment contract regulations 7702 and the IRS code. And none of my colleagues ever talked about borrowing against whole life. So this was totally new, and I'd been close to those products somewhat, even though I was doing more annuities. But it was a game changer. And recently, I'm probably going to have to come to you soon for a new policy because I'm getting aggravated talking to these banks, going through another refinance on a balloon payment I have coming up, and it just reiterates why I think these policies are a good use because you just never know how the banks are going to kind of change their underwriting or because right now I'm going through this underwriting, and it has become clear that they don't have a problem with the rental property I'm trying to refinance, but they didn't like that I was keeping so little money in the account. and now they don't want to lend me money again, which is like mind-boggling to me. But they saw that I was because I originally 5 years ago they had wanted me to keep like a minimum of $20,000 in the checking account as like a reserve fund. But I decided I'm not gonna agree to that. So then they said okay and originally agreed to it, but now they really don't like that I only keep like $100 like a month, and then I'm transferring the mortgage payment from another account and paying it. Because I said, well, would you lend me on a much lower amount? And they basically said no. So it's just you never know how they're going to like change their views on things, and it's really good to have more control long term.
Yeah, it really is about control. And I love that you brought this up, Jack. You're an example I bring up many people like you because sometimes when you talk about the idea that you can borrow against your whole life insurance policy while it still keeps earning for you, a lot of people look at that and say, well, I can borrow against my house. I can borrow against my stock market portfolio. And my response is always, have you ever tried? Like, have you ever tried really doing that at scale? Right? If you want to just take out a little home equity line of credit against your primary home and you have an excellent credit score and a W-2 job, sure, you can do that. No problem. But if you want to actually scale that up, because the people who raise that objection are people who have never actually tried it. Because the people who are most likely to jump on the infinite banking concept quickly and get it quickly are people like yourself who understand the challenges of trying to leverage other assets. It is a good idea, I agree, to leverage assets. You can employ the buy, borrow, die strategy to real estate, to your business, to any investment in theory. In theory, any appreciating asset, you could collateralize it, right? But now you're dealing with a bank. And the more you try and scale that up, the higher the risk the banks consider you and the harder it is to get loans. Whereas with whole life insurance, there's no bank involved. It's a guaranteed, the policy loan is a guaranteed option that you have. So it's ironic. And when people raise that objection, I also like it in that they are seeing this concept as bigger than just whole life insurance, right? Some people think infinite banking is just like a sales process for selling whole life insurance. That's not true at all, because you can employ this strategy with other assets, but only whole life insurance really enables you to become your own banker because now you don't need a bank's permission to do it, right?
Yeah. And I think if people really tried to borrow against it, it'd be interesting how much time is spent in those underwriting conversations. Because I bet at least this last phase I had with this bank, I've not missed a single payment over 5 years. Had a very good relationship with them. I probably spent, I would guess, 12 hours going back and forth,
Wow.
them wanting to see different things. And, each bank wants to see slightly different things or categorizes things slightly differently. They want to see a different split, and then you kind of have to modify. I would be really interested if someone did like a study on like the amount of time going into some of these refis and then kind of trying to capture that because that's the biggest pain point for me is just the time spent going through some of these refis. And to your point with it seemed much easier when you had a W-2 job. It's a different ball game when you leave
Right.
that realm.
Right. You can't just flip a switch and borrow money. And you asked about what am I seeing in the infinite banking footprint. I think there are two other things I'm seeing, which is me myself. I'm pushing more convertible term, encouraging people to, while you're doing your research and learning about the infinite banking concept, take out a convertible term life insurance policy for your full human life value that is going to protect your insurability. So now you have full optionality. I think you as a real estate investor can appreciate optionality, right? Um, if there's a piece of real estate you think you might want to buy, what if you could slap down a small amount of money and get a guaranteed purchase option where you can now buy that property anytime you want at the current market rate and you're locked in with the best financing deal, right? That's kind of what convertible term allows you to do. And then the other thing I'm talking about more is taxation, taxes, right? There's a lot of tax efficiency we can gain through the infinite banking concept and through other strategies. I try to help my clients any way that I can. And so I just take a look at their overall financial picture, and usually I'm able to help them in surprising ways. Um, One of them is taxation. We can talk about the Augusta rule. Can you implement the Augusta rule? I have a partner who all he does, 100% of his business is helping people implement the Augusta rule because there can be
Yep.
so much money on the table. A lot of people don't realize how you can leverage it. And people who implement the Augusta rule oftentimes leave a lot of money on the table. Um, and then along those lines, one of the most frustrating things I see is people who hear my content, are interested in what I have to say, and then they go and give the business to somebody else. I don't know why. That somebody else has never educated them, has added no value to them, but for some reason, I don't know why, they do business with somebody else. And invariably, they're done a disservice, right? They say, "Oh, I've got a convertible term policy." And I look at it, I'm like, okay, this is not convertible to anything good. So the fact that it's convertible doesn't mean anything. Or, okay, yeah, this is a good company, but do you know that they limit conversions? So if you try to convert it to the sort of policy you're going to want, it won't be allowed, right?
Mhm.
Or they'll take out a whole life policy, but they're not working with a real specialist. And it turns out, no, that's actually a variable universal life policy, not a whole life policy. Or it's an all base contract with a non-mutual company or things, all sorts of things. There can be lots of nuance under the
Mhm.
surface. Um, and then the biggest thing I think I see there, Jack, is that there's just not sufficient death benefit.
Mhm.
They go and take out a whole life insurance policy, but where's the convertible term policy that's going to secure your human life value, protect your family, and secure your future right to take out future policies? So I know I threw a lot at you there. Was
Yeah.
there's something
The
in
the
there you wanted to
convert
respond
the
to?
convertible term, I probably honestly I should probably get more of this. Like, how do you first like convertible term? Like, what would you sum up the great pros of that are? Is it just that like while you're healthy, go through the underwriting,
Right.
lock in that underwriting class?
Exactly. That's exactly right. You'll never have to go, well, if you do have to go through underwriting again, it'll be a good thing. It'll be because, oh, now I have more insurability, right? Because the insurance company is not going to give you an unlimited amount of death benefit. So
Mm-hmm.
whatever your human life value is today, let's say it's 5 million, lock that in with convertible term. It's very inexpensive. Hopefully you're still healthy enough to qualify. Now you can convert it at your leisure whenever makes sense. Now, hopefully at some point in the future, your income, your assets, your net worth goes up so that you'll have more insurability and then you'll want to secure more, but that will be a good thing, right? And
Mm-hmm.
if something has happened to your health, at least you got the 5 million locked in. So you still have options, right? But then also just the death benefit has a real value. Let's not undervalue the death benefit, right? I think there's a great peace of mind that comes, especially if you're married and especially if you have children. There's a great peace of mind that comes with having that death benefit protection, knowing my family is going to be okay no matter what happens to me. And most people don't have enough death benefit because they've never really sat down and been explained to them what human life value is. So they have 1 million. Sounds
Mm-hmm.
like a lot of money, doesn't it? Right. But if you die tomorrow and you're gone forever and there will be no more income, how is your family going to live off of $1 million for the rest of their natural lives? You know? Um,
So Logan, how do they calculate your one's life value?
yeah. Good question. So human life value can be calculated a number of different ways. Typically, it's a multiple of your income. So the insurance company looks at you, Jack Allwile, and they say, what is the measurable financial loss to your family if, God forbid, you die? Right?
Mm-hmm.
If you're 30 years old and let's say you make $100,000 a year, they're going to take your $100,000 a year and project it over your working life, typically 30 years. So that equates to a $3 million human life value. So if God forbid you die tomorrow, a $3 million death benefit will go to your family. That is not going to make your family rich. Let's just be clear. Your family did not gain anything. They simply replaced what was lost. Just like if you total your car, right? They'll pay you the value of your car, but you didn't make any money. That's why a death benefit is not taxable. There's no gain to you. We're simply replacing lost income. Okay. Um, and there are other ways to calculate it, like if you're retired and you don't have any income, but you have a large net worth, there's estate planning use cases, but typically it's your income projected over your normal working life. And there's a protection component to that. You want to protect your family, but there's also an offensive element to it as well, which is I'm securing my future net worth. Because the positive way to look at this is to say, Jack, if you play your cards right, you should be worth $3 million 30 years from now, right? So why don't you secure that today on a guaranteed basis, right? Step one is you take out a $3 million convertible term policy. You just took your first step to being worth $3 million on a guaranteed basis. And over the next 30 years, you're going to work and you're going to convert that 3 million to whole life over the next 30 years, right? How hopefully it happens quickly, but however long it takes, right? Now that 3 million is permanent, now you will be worth 3 million. It's not hypothetical. Dead or alive, at some point you will be worth 3 million. And then eventually the cash value accumulates to the point that you actually have 3 million liquid and accessible to you in those policies, right?
Mhm. Do they tend to look at business owners differently? Because I could see if a business owner were taking advantage, for example, the Augusta rule,
Mm-hmm.
which I actually did a video on like a couple months ago.
Excellent.
It's a cool rule. You should definitely look into it if you're a business owner. But like, how do they look at business owners that maybe are making a ton of deductions? Like, are they able to maybe go on a gross basis or?
Yes, and that's the beauty of it. We are not working with a bank here. We're working with an insurance company. So we tell them how much money you're making. So if you are grossing 500,000 but you're reporting 60,000 to the IRS, for the purposes of insurance, we can use the $500,000 number. Now,
Cool.
this gets back to work with a good agent. It all comes back to this, right? I'm telling you, you need to book time with me. I'm giving you a lot of information, education, but the call to action is not, oh, Logan told me everything I need to know, and now I can go do it myself or give it to my Northwestern Mutual guy. No, you need to schedule time with me because I can never explain everything. And there's a whole skill with navigating underwriting, making sure you get the most death benefit and the best health rating, right? And what policy is appropriate for you. But yeah, so um, typically that's where I come in and I will help you to explain it to I'll explain it to the insurance company in terms of what you're actually making. So that's typically not an issue for insurance purposes. It would be if you're trying to take out a bank loan.
And since you're pivoting into some of the tax mitigation, like what have you been seeing, like in broad terms, like in terms of working around taxes or trying to mitigate
Yeah.
taxes?
Yeah. So I start with just looking at what opportunities are there. So typically, if you, let's say you're a business owner, or even if you just have a small side hustle, there are a few strategies I'm going to immediately look to see if they apply. One would be the Augusta rule. So for those of you who don't know the Augusta rule, if you have a business, now there are lots of caveats to this. Again, schedule time with me. Don't try and do it yourself. But you as a business owner can rent your home, your residence to your business, right? You charge your business rent and your business pays you rent. You as a person collect that rental income tax free and your business gets a tax deduction of the rent because the rent is a tax deductible business expense. You can only do this for 14 days out of the year, though, because it has to be a residence. If you're doing it for more than that, then they might say, okay, now this is a rental property, not a residence. So the tax laws would change, tax treatment would change. And I have a partner who all he does is help people with the Augusta rule. And where people leave a lot of money on the table, even people who implement the Augusta rule, is they don't get the right comps. So when they look to see how much rent am I going to charge my business, they compare it to, say, a local Airbnb.
Mm-hmm.
Well, that's what a individual would pay in rent. But what a business would pay is highly dependent on the type of business and the type of business activity that you're doing. And that's where my partner helps people. It's not just about doing the paperwork for you to make sure you don't get audited. It's also getting maximizing the efficiency of it. What can you as a business owner legitimately do? And you can see triple or quadruple the rent rates if you
Mm-hmm.
if you do it correctly, right? So
Yeah, I
people
think
leave
I
a lot of
saw.
money on the table.
Yeah, I saw a great video. I think it was by Garrett Gunderson, and he was within the Augusta rule. He was kind of cherry picking the dates to get bigger comp. And like for
Yep,
example, like the World Cup's coming in June. Like the Atlanta Airbnb rates are going to be much higher around that World Cup. Maybe you should use your comps during that June or schedule a bunch of time, and then you'd be able to deduct more. It's like,
exactly right. Seasonality is another one. See,
yeah,
that's another nuance that the people who do it on their own don't think about, right?
yeah.
So So that's where my partner helps quite a lot. Another is the strategy of paying your children a salary. So again, if you're a business
Okay.
owner and you have minor children, I have a client right now, they have two children, 9 and 11, right? They didn't know you could do this. So they're now employing their children, 9 and 11 years old, minor children, paying them a salary. The typical number we see is about 15,000 a year, and it goes up every year. You can pay your children whatever you want as long as you're paying them the market rate, as long as you can justify it. Typically, it ends up being, I think it's gone up to 16,000, whatever the standard deduction is, because you can pay them that and they'll pay no taxes on that income and you don't have to file any tax forms for them. If you
Ah,
pay them more than that, it can certainly make sense, but now you have to file a tax form for them, a tax return for them, which it could make sense, especially if you're in California, New York, and they might pay taxes on it, but they're going to pay taxes at a much lower rate than you would, right?
uh-huh.
So now money is paid from your business account to a bank account with your child's name on it, right? But your child is a minor, so your child cannot shepherd those funds. So you, as the guardian, are going to shepherd those funds for your child, right? And as long as you're using the money for the child's benefit, which you're probably going to do anyway, then you're totally fine. And what we do, Jack, is what's one way you can use those funds for your child's benefit? You can purchase a whole life insurance policy on your child, right? Garrett Gunnarsson has talked about this publicly as well. So we take that $15,000 per year per child, which is now deducted from our taxes. We pay that as premium into whole life insurance policies on the children. So not only is that $15,000 not taxed, all the gains in the policy will not be taxed. The distributions will not be taxed because policy loans are not a taxable event. And then, of course, the death benefit that pays out hopefully long after you're gone, also not a taxable event, right? So, this one client, that's $30,000 per year that we just permanently removed from their taxable estate. And they're using those whole life insurance policies as college savings for their children, right?
Awesome.
Then we also look at, business structure. If you have a business, do you have the right structure? Should it be an LLC? Should it be an LLC with S corp filing status? Should it be a C corp? Right? We can look at more advanced use cases about how are you taking income out of your business. So as an example, you can take income out of your business, which if you're at a lower income level is typically what makes the most sense. You just have kind of a pass-through entity. But as your income grows, it could make sense to basically take loans from your business instead of taking income. And we can use a whole life insurance policy to collateralize those loans, right? It's called,
Hmm.
I don't want to, I'm going to open up a can of worms, but it's called a collateralized split dollar loan regime using whole life insurance. And the real
Okay.
power, Jack, is that when that whole life insurance policy, the cash value is transferred from the business to the owner, there's no tax consequences.
Okay.
So it is a great way to effectively get liquidity out of your business in a very tax efficient manner. Now, this is a more advanced use case. It only makes sense at higher income levels. Um, and so then for people who need more advanced tax planning, which would be if you're grossing over 300,000 a year, or if you have more than $100,000 of tax liability in any given year. I have a partner, Strategic Associates, where we do more advanced tax strategies. But first, we have the conversation to see, are you doing these more basic ones first? If you're not doing those, let's do those. And we've talked about tax efficiencies you can pick up with whole life insurance as well, especially if you're using it for investing. But if after implementing these more basic strategies, we still have a large tax liability, which oftentimes we do, then we can look at more advanced strategies, which then again, for all of these, you're going to want somebody else to actually implement it, like at least work with your CPA. But I know what questions to ask. And I'm sure
Hmm.
this won't surprise you, Jack, but the great irony is these ideas, these conversations are always being initiated by me, never by the CPA. Never, it's never the CPA. Now, CPAs do add a tremendous amount of value, but I think most people think that their CPA is a tax strategist. Really, your CPA is a tax preparer. There's value to that. He deserves to be paid for what he's doing because he is saving you time and money. He's helping you out for sure. but he is not being proactive, strategic, creative about thinking of ways to save you money on taxes.
Yeah.
And then the last thing I'll say on that is I would just look at your lifestyle and see, are there ways I can take lifestyle expenses that I have and legitimately turn them into a tax deductible business expense? And usually there are ways that you can with a small lifestyle adjustment, right? So then
Mhm.
it becomes a question of, are you willing to make this lifestyle adjustment so you can turn what was a vacation into a business trip, right? So now you have to do enough business activity to justify it. And now all those expenses become tax deductible, just as a simple example, right?
Cool. Um, I don't know what else you seeing.
So I love talking about taxes and convertible term. Those are kind of the two biggest. I'm actively growing my strategic partnerships, um, and I'm learning about how we incorporate whole life insurance and annuities into the portfolio. So there is the infinite banking concept, but there are also a lot of people out there, Jack, who they're not necessarily true believers. They can't get behind the infinite banking concept, which requires a high degree of commitment. Well, we're paying high premiums. We're really trying to become our own bankers. But there are a lot of people out there who see the value in whole life insurance as just a bond substitute in the portfolio or a savings account on steroids, especially if they place value on legacy. It's a great way to leave legacy to the children. So I'm learning that there are many people out there who will not sign up for the infinite banking concept, but they still want whole life insurance once they see how it can be designed and how it can be utilized. So I partner with my friend Peter Nelson with retirement income planning because he's securities licensed. I'm not. So he can give investment advice. I cannot. And with him, we can do a full-fledged true retirement income plan. And almost always we end up with a mix of investments, whole life insurance, and annuities. Those three working together. We recently did a video on an Ernst& Young report that explained the value of this, where the old 60/40 portfolio was you have 60% of your money in equities, stocks, right? And you have 40% in bonds, right? Now, what the Ernst& Young report suggests and what Peter and I are seeing is you want 40% in investments, 30% in cash value life insurance, and 30% in annuities. Okay. And that gives you a lot more optionality and a lot more safety because both the annuities and the life insurance are protected from the downside. There's no market risk there. So it allows your investments to perform better because there's not so much pressure on the investment portfolio. We can pause withdrawals from the investments in retirement. We might want to do that if the market is down. We might want to do that just to manage our tax burden and our IRMA consequences better in retirement because anything we pull from whole life insurance is not going to be taxed. With the annuity, it there are some tax benefits, but typically that the annuity is more about giving us guaranteed income,
Mm-hmm.
right?
I've been a little bit out of the game. What types of rates are the annuities paying these days?
So annuities are a whole other topic of conversation. So it depends on, so what you're thinking about is a single premium immediate annuity, which is not typically what we do. But a single premium immediate annuity is I'm going to take a lump sum of money. Let's say it's $1 million. I'm going to give it to the insurance company and they're going to give me a pension. They're going to give me a guaranteed income stream for the rest of my life. Why would I do that? Well, if I have $1 million, I don't know how long that's going to last me, right? I don't want to run out of money when I'm in retirement. So the insurance company will now guarantee me that this income stream will never run out. And the insurance company can do that because of how they manage mortality. How much they pay me, to your point, depends on my age, my gender, and where interest rates are. So the older I am and the higher interest rates are at the time I take out that annuity, the better the payout is, right?
Mm-hmm.
And that can work just fine. That can work just fine. What we typically see is what's called a fixed indexed annuity, which gives us more optionality. So a fixed indexed annuity is indexed. It's attached to a market index, any one we want, like say the S&P 500. Okay. And we will participate in that, but not directly. So we'll have protection to the downside. So let's say we have a 70% participation rate. That means if the S&P 500 goes up 10%, my annuity only goes up 7. But if the market crashes down, I have a 0% floor and I don't lose anything, right? At any point in time with that fixed index annuity, I can turn on the income. So I can annuitize it. And now
Yeah.
it becomes a pension, a guaranteed income stream. Or I can just take advantage of the free withdrawal feature, right? But clients typically like that option better because it gives them more optionality. Like once you turn on the income, it's irrevocable. There again, that could be a great thing to do, but
Mhm.
now you no longer have that access to that lump sum. There's some long-term care protection in there as well that can be layered in. And the net net is what we typically see is instead of a 4% withdrawal rate, which is what you can safely take from market-based assets, you can do more like 7% from a
Mhm.
fixed index annuity. And with the optionality we have, you could go higher on certain years. So here's a great play. The market crashes. We have a COVID crash, 2008 style crash. The
Mhm.
market has crashed 40%. So your investments are down, so you're not going to touch that. You need to wait for it to cover. However, there are screaming deals in the market right now, right? So why don't I withdraw 10% from my annuity? Why don't I take out a policy loan from my whole life insurance policy? Because now I have capital available. So I'm going to draw more income and I'm going to go and buy stocks on the cheap. And then 1 to 2 years later, I can sell those stocks and I probably got a double or a triple on
Mhm.
safe blue chip stocks like ExxonMobil or Microsoft, right? So that's just one example of how these three components working together can 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 make it can work together better, right? And so it's so counterintuitive because when you look at the annuity and we show a projection, you're going to look at a 0% year and say, "Ah, oh, I made zero. That's bad." Actually, those are the best possible years to be in an annuity because you're beating the market. Everybody
Mhm.
else lost money. You didn't. You're pulling ahead, right? That's probably the best possible years to be in the annuity, right? So
Mhm.
I know I rambled a lot there, but I'm learning
No, no,
about
that.
the key there is coordination. None of these
Mhm.
assets can show its true value when you look at it in isolation.
Yeah, I think because I learned about like index annuities, they're basically created by buying bonds to back the guarantee, and then they're buying call options for the upside. The thing about like the SPIA, from what I remember, the thing that was off-putting to me was that there's no inflation adjustment. So if you had really high
Correct.
inflation, those
Correct.
payouts to you in the future are fixed. They do not go up. Is that still the
Correct.
case?
Yeah, that is correct. There might be some that have inflation adjustments, but I'm sure you pay for that. The ones I typically
Uh-huh.
see don't. Now, there's one other thing though. They have mortality credits. So it's what you mentioned
Okay.
is not the full picture. It's life insurance companies that offer annuities
Mhm.
because they have mortality credits, right? So you can think of it this way. Three grandmothers put $250 into a jar. And then once the first two die, the third one can collect the full $750.
Okay.
That's one way to think about an annuity. It hedges longevity risk. So because the insurance company knows how to actuarially measure mortality, it's the inverse of life insurance, right?
Yep.
With life insurance, they're managing the risk of you dying too soon and they have to pay out a death benefit. With annuities, they're not balancing that. Now the risk to the insurance companies you live too long and they have to keep paying you this income,
Mhm.
right? So that's why your standard financial firm couldn't do annuities the way that a life insurance company does because they cannot give you mortality credits,
Mhm.
right?
Yeah, yeah. From their perspective, they have competing or like offsetting risks. They have mortality risk on the one side and then the longevity risk on the other side. I
Exactly.
guess, how
Exactly.
do you view, because I think a lot of people right now are really worried, or maybe the inflation risk is top of mind.
Yeah.
So the annuity might
Yeah.
not look as attractive if they're not capturing some of the upside of like the market or
Right.
so
Yeah.
how
And
do you kind of view that inflation risk right now?
I think that's where the fixed index annuity can be great. And by the way, let's say interest rates rise because of inflation. The
Hmm.
more interest rates rise, the better an annuity payout could potentially look. And inflation is a whole nother topic in its on its
Yeah.
own. I would just say that let me be clear, an annuity cannot solve every problem for you, right?
Hmm.
So if you are super worried about inflation, there are probably better tools out there than an annuity to deal with that. But you're never going to want all of your eggs in one basket, right? So that's why it
Yep.
becomes, in theory, investments should be very inflation sensitive. So if
Yep.
inflation goes up, those investments should more than beat inflation, right? Whole life insurance also tends to be very inflation sensitive because of the way that investing in long-term bonds. But there's a bit of a lag there. So you could still get hurt by inflation some. Annuities, if it's a fixed index annuity, that should be also inflation sensitive because it's tied to a market index. Where there would be a challenge would be, okay, if you've already turned on the income, then the income you make is what you make. Um, and then, if someone is more worried about a a worse scenario where it's not just inflation, but it's something about the intrinsic value of, say, the US dollar or whatever currency you're
Hmm.
in, there are other assets, alternative assets you can invest in that would do very well if something like that were to happen. So, yeah, I would say um, the annuity is not going to solve all your problems. If you're worried about inflation, then you can and you should have other assets that will address that, not
Yeah.
necessarily the annuity.
How, if you don't mind sharing, like, how are you invested? Like, how is your portfolio, like, percentage wise?
So I don't like thinking in terms of portfolio.
Okay.
I think of it in terms of cash flow.
Okay.
So how am I generating and optimizing my cash flow? That's what it's all about.
Okay.
How much money do I have coming in and how much money do I have going out? I see it time and again when we do retirement planning. The difference between someone who has a pension and someone who does not is massive
Hmm.
because a nest egg is not a pension, right? Now that's
True.
where an
Yep.
annuity can hopefully help. So when we're looking at retirement income planning, the key is income. You don't live off return on investment. You don't live off the nest egg. You live off of income. So the nest egg only helps you insofar as it can generate income, right? So my best investment is my business. And that would be my number one recommendation to everyone watching. If you want to become financially free in a reasonable amount of time, the vast majority of people who accomplish that started a business because a business pays you. A real asset pays you. It generates income, right? And it's more about the blood, sweat, and tears that you're putting into it, less about the money, although there will be some money you'll need to invest. Like you do raw land investing. That's what suits your investor DNA. That's what you do. And it's not so much about the monetary capital that you're putting into it. It's about the learning and the experience and the skill that you've developed where you've gotten good at it. Because I'm sure you know, if you can find the deals, then you can find the money, right? You could go and have no money, but if you can find a deal, then you can get investors to sign on to your deal, right? So I don't like thinking about it in terms of portfolio because a portfolio is static. It asks, where is my money sitting? But I
Hmm.
don't want my money to sit. But to answer your question more directly, I think what I and most successful people do, not necessarily consciously, is what's known as the barbell strategy. You ever heard of the barbell
Hmm.
strategy?
Yeah. Yeah.
Yeah, I don't think people consciously do it. I think just it happens naturally where you're going to end up with a lot of money in safe, liquid, accessible capital on the one hand, whole life insurance policies, hopefully, but it could be savings accounts, it could be gold, it could be in HELOCs, just whatever you consider to be safe, liquid, accessible capital, right? Earning at a reasonable rate, 4%, but not really taking on any risk, right? That protects you, it keeps you safe, it keeps you liquid, and it gives you the ability to take advantage of deals when they come up, right? And when you're sitting on a lot of capital, you will be much more disciplined as an investor. You will not feel this pressure to put your money to work for you because your money is working for you. And you'll be like Warren Buffett, like the alligator. You'll be very patient and waiting for the best possible deal. And when that deal comes, you will not need me or anybody else to push you or persuade you. You will know. And the right deal is specific to you, which gets to the other side of the barbell, which is then you'll have a large amount of value in whatever your primary business or investment is, whatever you know really well. I'm not diversified. Warren Buffett doesn't believe in diversification. He calls it diversification, right?
Okay.
The only reason to diversify is if you don't know what you're doing, right? So you do raw land flipping. That's what you do. That's what you know. That's where all of your accessible capital that's earmarked for investing is going. That's what you know. My best investment is my business. That's what I'm focused on growing. I've developed a tremendous amount of skill. I'm still not very good at it, but I've learned how to market better. I've gotten better with sales. I'm always networking, right? And I've developed a tremendous amount of skill in designing whole life insurance policies and just solving people's financial problems. So that's the way I am. A lot of money in safe, liquid, accessible capital, and a lot of, I'm going to say value because it might not necessarily be monetary, but a lot of value in this business that I'm building.
Hmm.
And not much in the middle. I don't really play in the market very much.
Hmm.
If you want to, that's fine, as long as you're willing to do the research to really know what you're doing.
Yeah. I knew the when the first time I heard that phrase barbell strategy was from a Nicholas Taleb book, and the way he was kind of framing it was, and I think his percentages were like 80% super safe. And at the time when he wrote it, he would put like 80% into like US Treasury. That's what he considered super safe. And then the other 20 were super volatile, like way out of the money options, things like that really capture that don't move in linear fashions. They're really like exponential if they really start moving. And he would kind of just, but he kind of was coming at it from um, like a black swan event actually happens more than what people would think. And you want to have exposure to those types of things, and you want to kind of check your ego at the door and understand that there's a lot of unknowns. So he would actually like actively put it in just random things, like random, very out of the money options. And that's what he referred to as the barbell strategy. I kind of view now, I would say the whole life policy I like is like the foundation where I have a lot of like the kind of the safe, methodical growth, and then you kind of layer in, yeah, what your specialty is, and you can borrow against it, and then kind of go play.
Correct. Correct.
Um,
Absolutely. Yeah. Marin Katusa uses the analogy of the
ah,
alligator, right?
okay.
What does the alligator do? He's an apex predator. What does he do? Most of the time, nothing. He just
Uh-huh.
sits there pretending to be a log, lying in the water, just waiting, right? It's only when a nice juicy prey comes close by that all of a sudden he springs into action and grabs it. Great deals don't come along every day, right? So you look at Warren Buffett, Marin Katusa, Rick Rule, a lot of these very successful investors and speculators. Most of the time, they're just sitting on the sidelines with capital. That's what they're doing most of the time, right? And of course, your capital is working for you. It's earning a safe return, and it's your big gains in waiting. It's not idle money. It's the opposite of idle money, right? If you're just putting your money into the S&P 500, that's what I would call idle money. And you're taking
Hmm.
on more risk than you should, and you're investing in something you don't understand. Your average person has absolutely no understanding of how the stock market works, how Wall Street works. They don't even know what they own, you
Hmm.
know.
Yeah.
And I would suggest to everyone, don't invest in something you don't know and understand. Take the time to learn something. And if you don't, guess what? Investing is not required. If you don't, then just keep working your W-2 job and patiently building capital in a safe uh, vehicle like whole life insurance. And you can absolutely get wealthy that way. And you'll do it with a lot less stress and headache than chasing
Hmm.
after returns. And it'll serve you a lot better in retirement. So if you do not really want to take time to get to learn something, that's fine. Then just don't invest or view your full-time job as your primary investment because that's really what you're saying. Because your best investment is whatever pays you the most. So if
Hmm.
your full-time W-2 job is paying you the most, then great. Invest some time and effort into getting a raise, getting a new job, adding a side hustle, things like that. It's all about increasing your income. And what I do with all the strategies is I help to optimize it. So let's reduce your outflows by reducing how much you're paying in taxes. Let's get more efficient with how you're managing your cash flow. So now you keep more of it, right?
Hmm. Yeah, I feel like I think about this a lot, and I'd like to do a deep dive on like, yeah, because to your point, a lot of people blindly put money into their 401k. They don't really know what the money's going into, and that would, one could kind of conclude from that maybe some of those valuations in the market are overvalued because people there's just like this kind of inherent bid for these things that are just bidding up the prices. And I'd be curious how. when people are blindly pulling money out, how that's going to go, or like, I don't know, that those types of mechanics are always like in the back of my mind. I'd like to investigate more, but yeah, you need to think about where your money's going. Long story short.
Right. And I would call
Um,
that speculating. So
yeah.
I like to make distinctions. To me, investing is what you're doing with raw land because it's giving you cash flow. It's paying you. If I buy long-term buy and hold rental real estate, that's paying me. If I start a business, these are investments because they're giving you cash flow. If we're talking about returns, now we're talking about speculating. It's saying, I'm going to take some of my
Okay.
money, I'm going to put it at risk in some asset and hope that it goes up in value so I can then sell it later and make a gain, right? So
Hmm.
my first question to everyone who's putting in the market is, when are you going to sell? What's your
Hmm.
distribution strategy? Because they haven't thought that far ahead, which is a problem. If you're going to buy something and the only way you make money is by selling it, then you need to know, when and why am I going to sell it? So I would call that speculating. And if you're going to speculate, I would do what you suggested earlier: take small amounts of money and put them in very high potential speculative stocks or whatever you're investing in,
Hmm.
right? Where you can get thousands of percent return. So the upside
Yeah.
is very high, and you'll limit your downside by just having small position sizes, right?
Hmm.
And what'll happen is probably 70% of those will go to zero. But if only a handful of them work out, then you make outsized gains. That's
Yeah.
intelligent, disciplined speculating.
Hmm. Yeah. The investing, speculating, saving discussion is kind of interesting because at least investing and saving, I feel like have been blurred because, well, back to the inflation thing, people are kind of they feel like they have to do something, and a lot of people will even say, I save with my 401k. Like that line is kind of blurred in
Mm-hmm.
today's day and age.
Mm-hmm. Yeah, I totally agree with you. Make drawing that distinction is important, and a lot of our, Wall Street types will get upset and deliberately try to blur that distinction. A 401k is not a savings vehicle. It's not to say it's bad. Let's just call it what it is. It's not a savings vehicle. It's investments is what you're doing, and I would say speculative investments typically. Now, I suppose I could grant if you're putting money in a 401k and you're just putting it in a money market account and that's all you're
Hmm.
doing, then I suppose you could call that savings. The only challenge there is now you're giving up liquidity, right? Because the whole point of savings is to have money liquid and accessible so you can tap it anytime you want. Money in a 401k is not accessible. So I would say in that sense, it's a very inferior savings vehicle. Again, it's not to say a 401k has no use or has no value. There can be use cases for it, but let's be clear on what it is and what it is not. Because you're right, when Wall Street keeps mislabeling it as a savings account, it leads people to think that I can just keep putting money into it. But that's really
Hmm.
not the way you should use it, in my opinion. If it were a savings account, that would be fine, but that's not what it is.
Hmm. Well, Logan, I always enjoy talking to you. I feel like I could talk to you for a lot longer, but I know we're coming up on time. Why don't you tell the listeners where they can go get in touch with you, learn about your services?
Yeah, youtube.com/Hazeltine LLC. That's Hazeltine LLC. Of course, I've made my name as difficult to remember as possible. Um, and that's really the best place to find me. I do have a website, hazeltinellc.com, and then you can find me on LinkedIn as well. Just look up Hazeltine LLC. But really, my YouTube channel is my primary prospecting tool. Jack, I agree with you. I always enjoy our conversations, and there's never enough time to talk about all the things we want to talk about. So it's probably good that we have a hard stop. Otherwise, we'd be here for hours. but
Yeah.
but yeah, I really appreciate your insights, and I congratulate you on all your success in raw land investing. It's great to see people like you succeeding and getting ahead. It's just a reminder to the rest of us that you can do this. You can reach financial freedom. It is within your grasp if you're willing to put in the work.
Likewise, Logan. Yeah. Great talking to you, and hopefully we'll chat soon.
Thanks, Jack. Bye bye.